there may not be any more short-term hikes. Quantitative tightening, though, is still alive and well. What's really interesting is if you look at the Fed balance sheet, it actually is shrinking. Now, it needs to shrink, right? They made, I believe, maybe the greatest policy error of all policy errors back after the lockdowns in 2020, where they doubled the money supply over an 18-month period. I mean, just absolute insanity. And what people call inflation, to me, isn't. It's just currency devaluation. We just devalued the currency by 50%. And that was crazy. And so they're trying to clean that up. And so quantitative tightening actually is alive and well. In fact, for the first time in 100 years, just let that hang there for a second. 100 years, we've expanded the M2 money supply. Every month, month in, month out, on average, about 7.5%. I mean, that's crazy. So for the first time, we are now contracting the M2 money supply. So I think it's an interesting dynamic. The bulls are out saying, look, Fed fund futures are predicting, rate cuts next year. Right. Well, why would they cut rates? Let's think about this. Only if the economy was sucking. That's a technical term. So otherwise, why would they cut rates? What I think people are confused by is most market participants today grew up in this era of craziness, right? Zero interest rates.
Right.
And they think that's normal. It's not normal, right? We had a 10-year period following the global financial crisis, and we had about a 7-8 year period in the late 30s and early 40s. That's it. The rest of the time, rates average somewhere between 5 and 7.5% on the short end. And this idea that we're suddenly going to go back to zero rates just doesn't make any sense at all. Capitalism doesn't work at zero rates, right? There has to be a premium paid to lend your capital to someone or to invest your capital in equity. You have to have a return on that invested capital. So, yes, people are excited that, people are predicting Fed cuts next year. But here's the crazy thing. For 13 years, from 2009 to 2000, I guess for 12 years, to 2021, people anticipated that they would raise rates, and they never did, right? And so that group of people that are the experts have not been right. And when it's the Fed leading that charge, they're never right, right? Their own expectations of things like CPI and rates is always off.
Hey, money talkers, brace yourselves because Grayscale is back in the game with some major ETF maneuvers. I'm your crypto guide, and this is your ticket to the Grayscale ETF Blitz. Let's dive into the action-packed world of finance. Grayscale is on fire. After a power-packed meeting with the SEC, they're charging ahead with plans to transform their Bitcoin trust into a spot Bitcoin ETF. Yep, you heard it right. They're aiming for the ETF throne. The proof? The brand spanking new prospectus filed on November 22, outlining their master plan. Let's talk money. Grayscale is making waves by changing GBTC's ticker to BTC. Analysts are buzzing and the SEC's in the mix. Bloomberg's ETF expert, James Seifert, spills the beans, saying Grayscale is in deep talks with the SEC, fine-tuning their game plan based on some regulatory chit-chat. Guest is joining the Grayscale fiesta. BNI Mellon, America's oldest bank. Grayscale's inked a deal, and BNI Mellon is not just an attendee, they're hosting the party. As the transfer agent for GBTC, they're managing shares, handling communications, and keeping shareholder accounts in check. Big moves, right? It's not just a meeting, it's a showdown. Grayscale's meeting with the SEC is making waves, and the term uplisting is causing a stir. Nate Gerasi, ETF store president, says if Grayscale uplists GBTC on the same day as others launch spot BTC ETFs, it could rule the ETF kingdom. And the odds? Bloomberg analysts are giving a 90% chance of approval by January. SEC, don't snooze on this. Crypto champions, that's a wrap on Grayscale's ETF Blitz, the SEC showdown, ticker twists, and BNY Mellon joining the crypto party. Let's continue our discussion with Mark Yusko.
I don't think we're going back to emergency liquidity measures, right? I don't think we're going to have another emergency like the global financial crisis. I think we're going to have a pretty meaningful slowdown. PMIs have rolled over hard. Consumer confidence has rolled over hard. There are a lot of things that are pointing to much lower economic activity next year. And I think that may push the Fed to act. I don't think they're going to act very much, because I don't think it's going to be this big deleveraging like we saw in the global financial crisis. We had the third largest bank failure in history earlier this year with Silicon Valley Bank. And people brushed that off like it was nothing. Now the Fed, threw $300 billion into the markets overnight and kind of saved everybody and guaranteed all the deposits. And that was the reversal of almost a full year of QT in 2 days. But now they've pulled that back out. They went back to quantitative tightening. So look, at the end of the day, higher rates are necessary for the banking system to flourish. The reason we had low rates for so long was we were basically trying to re-liquefy a bankrupt banking system. Mm-hmm. The banking system in the global financial crisis got out over their skis. They got too much leverage. They collateralized a whole bunch of crappy, again, another technical term, assets in the form of subprime mortgages. And everybody lost a lot of money. And the banks were basically bankrupt, right? Citigroup stock was down 99%. JP Morgan was down 95%. And they all should have gone to zero. Mm-hmm. But as one of our managers, Chase Coleman at Tiger Global, said, it was inconvenient for too many people for those stocks to go to zero. So they didn't go to zero. And by saving them, by bailing them out, by giving them $700 billion of taxpayer money to bail them out at the bottom, then we had to re-liquefy their balance sheets. Well, how do we do that? Well, you let them borrow from the Fed at zero. So I don't know about you, but I never got to borrow at zero. Fed funds, I don't get access to that. So it was only the banks. The banks borrowed at zero and they bought treasuries. And that was a great trade. You made 3% risk-free and you could lever it up 10 times and have no down trading days. But then Jerome Powell comes along last year in 2022 and says, party's over. I'm raising rates. And so all these banks that got stuffed with those bonds lost it, right? Consumer banks, regional banks, some of the big banks, not the big banks, right? They were protected and they were bailed out with the emergency financing from the Fed. And then, shockingly, JP Morgan got to buy all the good assets from the bankrupt companies, which they always do. Look at Washington Mutual, look at Bear Stearns. It always ends up at JP Morgan. So now we're at this point where short-term rates are higher. They're still not paying depositors very much. I don't know if you looked at your deposit rate lately, it's still 0.5%, 1%. So they're lending at 4 or 5 or 6 or 7. They're paying 1. That's a net interest margin that's really high. So bank profits were doing pretty well. Bank stocks were up for a while. Then they kind of crashed because people got worried about an imminent recession, and stocks started to roll over in the summer. And then we got to November. And in November, everything's sunny, right? Stocks are up 10%, everything's rallying, bonds are up, rates are down. Well, what changed? Well, what changes every November? So there's a rule that happened back many, many years ago that changed the fiscal year end for mutual funds. So they used to trade on 12/31 year end, and then they changed it to 10/31. So mutual funds have to unload all their trades before 1031 in order to qualify for the current tax year.
Following the settlement with the U.S. Department of Justice, DOJ, Binance, the world's leading crypto exchange by trading volume, has experienced a significant withdrawal of approximately $1.7 billion in digital assets, as reported by Nansen, a blockchain analysis company. This substantial outflow of funds from Binance occurred shortly after the settlement. As of the latest update, Binance's diverse array of digital currencies amounts to a total value of $64.98 billion. A U.S. lawmaker has called on Congress to focus its efforts on bringing more crypto activity and opportunities to the United States in order to bolster U.S. national security. Citing the Department of Justice's action against crypto exchange Binance, the lawmakers stressed that Congress does not need to rewrite laws that work in the crypto space. If you enjoyed the video, don't forget to give it a thumbs up and subscribe to our channel for more daily updates. Remember, knowledge is power, and we're here to empower you on your financial journey. Until next time, happy investing.